Hey there, fellow TSP investors. This is Scott, and as of last week, it was the end of the first quarter of 2019. With each quarter, I usually do these presentations to show you what I think of how the S&P 500, or uh, for those of you in TSP, the C Fund, how the S&P 500 did over the last quarter, and what to expect from it over the next several quarters. Also, this is intended to show you whether I think the S&P 500's price is too low, adequate, or too high relative to earnings. For those of you who don't know, stock prices are fundamentally driven by earnings. What earnings have already been reported, and what earnings are expected to be reported in the future. Those are the key drivers of stock prices. There are some shorter-term effects like speculation, which can be based on politics, geopolitics, or any other number of things, sometimes economic reports. But ultimately, what earnings actually are being reported and what expectations there are over the next year tend to be the most fundamental key driver of what share prices do. So if you want to know how the index is actually performing compared to expectations and what to expect over the next year, this is a presentation for you to watch. Okay, so I'm going to move on to my PowerPoint here. Okay, so it's just going to be for the first quarter of the year. These are the areas I'm going to cover. As usual, I do the same presentation every quarter. For those of you who are new to who are new to my group on Facebook, or maybe also new to watching me on YouTube, but I'll cover these in a little more detail on each of the pages. So I don't want to have this presentation go too long just trying to explain each of these right now. So let's move on here. Okay, so starting out here, have the index-wide performance results. Look at the very bottom here at the darker orange. That's what happened over the most recent quarter, and basically the effective earnings, index-wide earnings on that particular quarter. There are 505 tickers in the index. There's really only 500 companies, but 5 of those companies have have 2 stock symbols each on there. Basically, they have an A class and a C class shares that are both in the index. So that's why you'll see more than 500. Why didn't you see 505? That can be because companies they delayed their reports to after April 1st, or actually I should say April 1st or later. Or sometimes companies report earnings more than once in the same quarter. I don't go by fiscal quarters when I'm looking at my data. I only go by what day did they actually report earnings. I only care about companies if they actually reported earnings between January 1 and March 31st. I don't care what fiscal quarter they reported it for, or anything else of that matter. It's because it's all going to even out in the end anyway here. But overall, the intent here with this particular page here is to show you how the index performed, or earnings performed index wide relative to other quarters. This actually was a pretty decent quarter. Actually a solid performance of just over 14% year-over-year growth. So what this 14% is a comparison of this 745 to this 608 right here. So comparing, or actually not 608, the 664. You have to compare the same quarter, or compare one quarter's performance against the same quarter the previous year. The reason why is because companies have cyclical tendencies as far as their profits are. I always like to bring up H&R Block as a prime example of that. They usually always are in the red for 3 quarters out of the year, and then they'll have one really huge quarter in the black when it's tax time. And then that one quarter in the black during tax time more than makes up for all of the red that they are in the rest of the year. So that's an example of why you always compare one quarter against the same quarter the previous year. And and never compare one quarter against the adjacent quarter. But we can still get an idea of, looking at adjacent quarters on this part in terms of the percentage changes. Actually, what's most interesting to me here, or my particular purpose for this, is to see the percent change, as well as how much positive breadth there is across the index. I want to know how many companies in the index that actually reported at least some sort of earnings growth, some sort of positive growth. So what it does is, I get the idea right here, what percentage of the index overall actually reported positive growth. And you can also see right here how many reported about the same as what they reported the previous year, and then how many reported declining earnings over compared to last year. Okay, so look at compare this to the previous quarters that I've been keeping this record on. 14%. It's a little bit higher than what we saw through most of 2017, but it was definitely lower than everything we saw in 2018. That's not a real concern at all to me, though. 14% positive growth over an entire index is actually very strong, and 2017 was a strong year itself. So this is nothing to complain about. Also, the positive breadth here, there were 353 companies that reported positive earnings growth. It's actually right in the ballpark of what we were seeing the previous year. So in reality, what we got here is they have more companies reporting positive growth in first quarter of 2019 than there were in first quarter of 2017. And on top of that, it was a stronger percentage as well. In terms of, 352 here versus 353, this might give you a better idea, as far as the single quarter is concerned, how strong the quarter was. As you see, just over 14% out of 353 companies. That's still more than 1.5% better than what we saw from the second and third quarters of 2017, when there were 352 companies both reporting growth that quarter, or those quarters. Also, the percentage of the positive, just right in the 70% range. This is actually what I would call a more normal, healthy kind of growth rate. What we had during 2018 was just astronomical the entire year. Man, it was not sustainable. So, yeah, it's great for our account balances to shoot up really fast like that, but we also want to have a concern: is it growing too fast relative to what it really should be doing? And I'll get more on that later. But 70% is still a very healthy economy. When 7 out of every 10 companies in the index is reporting positive earnings growth, that tells you things have gone well. So, anyway, that covers this particular slide. I'm going to go ahead and move on to the next one. Okay, this slide here is meant to give an idea how the index performed, how each of the sectors in the index performed relative to what I expected from them at the beginning of the quarter. And also it gives you a total at the bottom of basically comparison of what I expected index-wide versus what actually did happen. As you see here, 8 of the 11 industrial sectors actually outperformed their expectations. The highlights were real estate and communication services, as far as how they performed relative to what was expected from them. Financials didn't do well at all. They were the laggard as far as this was concerned, but there is a little caveat here, or a catch-22, whatever you want to call it. A lot of what happened with the financial sector was caused by a single company in the insurance industry reporting really, really strongly negative earnings. I don't know what they have going on. The same company had the same problem the same quarter last year as well. So they might have some irregular one-time things going on that are causing that, but it did impact the entire sector because of that one company. Overall, though, really wasn't bad at all compared as far as comparing actual performance versus expectation. I was expecting plus 14.34% earnings growth this over the quarter, and what really got was 14.08, or actually 0.05. A little bit of rounding issues here is why you see a little bit different number here than you saw in the previous slide. But again, with that one company reporting strongly in the red when they were previously expected to report in the green. That might have had something to do with this too. As an index as a whole, we might have actually had a performance that met or beat expectations if it hadn't been for that one company. I'm not going to dig into those numbers there or discuss that part, but I'm going to speculate that has something to do with it, and we would have been much closer to at parity with the expectations, if not actually better, if it wasn't for that one report. So all in all, things are looking decent enough here, still healthy, and nothing to really be overly concerned about here. As far as is the bull market going to end, or is recession coming, whatever. But regardless, all right, we'll move on with this now. Okay, this is a price chart of the S&P 500. As I mentioned, the C Fund again. Really, what it does is it gives you an idea of where the price, where the index ended the quarter relative to where I think it's valued. Where I think it's valued is actually anywhere in this red to green range, right in here. You see, the price is was still low. And the white line here is what I call the current or baseline value, which you can find in the announcement post on the Facebook group. That's the amount that I think the index is worth, if you only consider trailing earnings and nothing else. The yellow line up here at the top, what that is it takes the white line, or the trailing earnings, and then factors in expectations over the next year and comes up with a different baseline. So in other words, what this means is that over the next year, this white line should eventually climb from where it is now to where the yellow line is, and then the yellow line will hopefully keep climbing up higher and higher as well. Now, what'll eventually happen is when earnings do flatten out, the white and yellow lines are going to be around the same level, and when that does happen, the solid red line, which is where I think the max short-term value of the index is, or at any given point in time, I don't think the index should be priced any higher than that. It should be below, at or below the solid red line, but normally at or above the green line as far as normal volatility conditions are concerned, from my experience. But what we do see here is it's still lagging. The volatility is not high at all. The CBOE volatility index, or also known as the VIX, which is another indicator that investors commonly use. That number is in the 13s right now, which is actually a very normal volatility number. So investors aren't really panicked, but at the same time, the current price still appears to be lower than where it really could be. Over this last week, we've actually had some really solid performance out of the index, and it's getting closer and closer to where it really should be. But as you see, 3010 is where the index is valued with trailing earnings only, at least by my estimate. And with the forward estimates factored in, today's value, it could go as high as 3100 and be okay. Any higher than 3100, then we start to get to where I think we're overvalued, and prices are due to come back down for at least short term. So that's how you basically read this information here. All right, let's move on now. Okay, forward growth projections. I just want to really give you a basic idea of what to expect from each of the next 4 quarters. Ultimately, this is what you're looking at here. So what this is telling you here is this next quarter, don't expect much of anything different. I would barely even expect about a 10-point difference in where that white line sits on this chart here. You see 31.10. So in other words, at the end of the second quarter, I wouldn't really expect that white line to climb any higher than 30.20, which is not much at all. The yellow line, that's another can of worms. We won't know where that yellow line will go until companies start to really report earnings over the quarter, and basically all these numbers here start to shift their way up, and a full new quarter works its way into the fourth quarter. So what will ultimately happen over the quarter is this 30.18 will eventually come up here to the 3008, whatever. 30.65 will come up to 1 quarter out. 96 will come out to 2 quarters out. 31.83 will come up to 3 quarters out, and then another number will come in as the fourth quarter out projection. So, needless to say, I don't expect much movement out of these valuation levels at all this quarter. I will see a little more change over the next couple of quarters. Not a heck of a lot, but 4 quarters out, or basically first quarter next year, or is it second quarter? First quarter of 2020 actually looks a lot more solid. Almost more than 5.75% year-over-year projection for that particular quarter, and an expectation of 85 to 90 point increase in where the white line will be. So we're looking forward to that. I just want to see if the subsequent quarters after that will be anywhere near as strong as what that'll be, because if the subsequent quarters come into this table here looking like this one here, we're going to see plenty more gains than from the stock funds and TSP. All right, let's move on here. Historical price versus earnings data. What this does is I want to get a good comparison of what the index price has really done versus what the index earnings have done. Again, like I mentioned earlier, stock prices fundamentally follow earnings. So if we know what's going on with earnings, we know what should be going on with the price also. When prices do something different, then it requires an explanation of, hey, what's going on here? Why is it higher or why is it lower? Ultimately, what we have here is, also, before I get to that part, the shorter the period is you look at, like say for just a single quarter, the more volatile it's going to be. So comparing the quarter performance here versus quarter performance here, you're going to see much different results a lot of times. But over a longer period of time, like a 12-month period and 24-month period, and if I even want to add in like a 36 or whatever, the longer the period gets, the more smooth the differences should be, or they should have a little bit more resemblance of that parity with each other over a longer time frame. So over the 12 months, as you see, the index, the actual price performance was in the teens over the last few years, pretty much, until it went to negative 6.24% in the fourth quarter of 2018. Again, that was caused by the correction that, as I've always been saying, was not justified. And this table tells you why I say that's not justified, or to an extent. This only shows trailing earnings data, doesn't show forward projections. So, and here's the problem though, is prices factor in both trailing and forward expectations. Earnings here are only showing trailing, so we're only getting half the picture here. But as you saw from the previous slides, there I am expecting positive growth, so we shouldn't have seen negative growth over here. So, but looking over 24-month though is what's most interesting. Over the most of 2018 and the end of 2017, when I actually had 24-month data to work with, as you see, it was hovering right around that 30%, even got up to 34 plus at the end of in third quarter 2018. So that's pretty solid performance. Now, how did it really compare to what the earnings actually did? Actually, in the same ballpark here. You see, at 29%, and as far as the third quarter of 2018 was concerned, and an actual performance in fourth quarter was almost 37%. So this is solid earnings growth, and what you see here is the price was actually pretty closely resembling what actual earnings were at the time until fourth quarter of 2018. Again, this is one of the ways that I can tell you that I believe the S&P 500, actually stocks in general, got ridiculously sold off to obscene levels that were not even remotely justified in the fourth quarter. We got some of that back. We didn't get all of it back, but it was still a solid performance this quarter, first quarter of 2019. We still have a way to go, though. As you see, like I said, just trailing earnings only, I'm at 30.10. And like I said, we could actually see stock prices go up to 3,100 and still be okay priced. So reality got more than 250 points off from what the trailing only price was, and about 270 or so points off of where it could really be in the immediate term right now. So we still have more gains that can be seen, is ultimately what this is telling. And this is all good important information for you if you're going to be a savvy investor and know what things to really be looking for and how to really value stocks, or whether it doesn't matter if it's a company, an individual company's prices, or a broader index like I'm looking at here. All right, moving on. Okay, looking at bond yield data. Now, this one is from fourth quarter. I just want to show you how fourth quarter compares to what we just ended first quarter with. What it says is a comparison of all the short-term bonds over here to the long-term bonds here. We did have a little bit of flattening, a little bit of an inversion here between the 1 year and maybe the 7 year. So the 1 year was almost where the 10 years are, 2.63%, 2.69. So it wasn't an inversion at the 1 year, 10 year, but the 1 year actually did invert from the 2 year, 3 year, 5 year, and 7 year back in fourth quarter. Why is this important to us? Because generally speaking, it's believed that when yield curve inverts, what happens is it becomes increasingly less cost effective for banks to borrow money themselves, which they do at the shorter end over here, to leverage their profits by lending out money to their clients at this longer end. So if you want a home mortgage, those are normally a 30-year loan. This is a 30-year mortgage bond right here. So 30-year mortgage rates are often based on what the 30-year bond yield is. The higher the bond yield is, the higher your mortgage rate's going to be. The lower the bond yield is, the lower your mortgage rate's going to be. It's basically what it is. But if it costs the banks more to basically acquire the money that they need to give you that, the cash on the money for your loan, and not to mention you, the consumer, are not the only person who borrows money. Businesses also borrow money, and businesses use that money to finance future growth. Businesses are no longer able to finance their future growth, and it stalls that's when the economy begins to stall out, and eventually gets to where demand might drop, earnings might drop, people will start losing jobs, and we'll start seeing problems in other areas show up, and the whole recession snowball will begin. We should see all that taking place before it actually does happen, though. It's just like I said, it's just like a snowball. It'll start out small. We'll eventually see more and more things develop that are problematic, and it'll all develop into a bigger problem later on. But thing is here with bond yields, there's a problem with paying too much attention to bond yields and whether they inverted or not. Just because U.S. bonds or Treasury notes are inverting some doesn't mean that it's no longer cost effective for banks to leverage their profits. U.S. Treasury notes and other domestic bonds are not the only places that American banks can, or financial institutions can acquire money from. They can also borrow from foreign sources, and so you got to look at what's going on with foreign bond markets also, as well as currency exchange rates as far as those are concerned. Yeah, that's a lot more. That's a much deeper issue there than what we can even comprehend on our end, and it's not worth, not something to really be overly concerned about. But trust me, the banking professionals, they're looking at all this stuff. They use matrices, whatever, to figure out what's the most effective way to borrow money themselves, so they can lend it out to others. And they'll continue to do that as much as they can, but just know that there's more than just domestic bonds. So don't get overly paranoid when we see inversions going on with the U.S. bond market. A lot of the media likes to keep talking about this and how it's always an omen that a recession is within a year or two away when the inversion does happen. But as I say, there's a lot more to that story. There was an inversion for several months, and then it starts working its way back toward a regular inversion by the time stock prices tend to top out and begin to fall at the start of a recession. Or actually, when they start a bear market. Recession is a completely different thing. Recession is basically defined as 2 consecutive quarters of negative GDP growth. Bear market is just stock prices, and stock prices, like I said, are based on mostly on stock earnings or corporate earnings. What are the companies whose shares you're buying and selling, whatever? What are they actually reporting? Anyway, this is let's look at fourth quarter here, and then I'm going to go ahead and move on to the first quarter this year. We still have an inversion going on here. It does not look too good, but it's not overly concerning either. 2-year, 10-year is still not inverted. You see 2.27% versus 2.41%. Now, something you should be thinking about here also as an investor is how much bang can you get for your buck? Okay, a smart investor is not going to move to bonds just because they see, because they think that the stock market's going to collapse because of a bunch of speculators. What they do is they're going to move to bonds when they feel that bonds are just a better place to invest their money than stocks. If you had bonds that were giving like a 10% yield and stocks were giving a 5% yield, which one would you invest your money in? You'd probably go for the one that will give you a 10% return instead of the 5% return, right? That's what my point is here. Don't get so fixated on inverted yield curves or anything to that effect. And something else to consider here is previous recessions that are bear markets and recessions. Normally, these bond yields are more than twice what they currently are right now. Prior to bear market, prior to stock market peaks at the beginning of bear markets, whatever. Normally, we'll see bond yields actually climb up to over 6%, and they tend to drop back down to into the 5s for a while before the stock prices actually top out. Now, again, when bond yields are at 5%, 5-6%, but then stock earnings, I should say, yields start get down to where they're less than 5. That's where it becomes an issue of, hey, maybe you should have your money more focused on the bond funds, because it's not that you're afraid of what's happening with stocks. It's just that you want better performance. You want to have your money where it's going to perform the best, so put it where it's going to get the best results. The best results are, if it's implied that the best results are going to come from bonds, then move to bonds. That's basically all that entails. But moving on, actually, speaking of that, this is what we're currently looking at as far as the next year is concerned. You see the 10-year yield is at 2.41%. My current expectation in 12 months for the S&P 500 is at 5.83%. So what this tells you is that stocks are still a better place to be than bonds as far as I'm concerned over the next year. If you can handle being 100% in stocks, great. Go for it. The more money you have invested in the funds that are expected to perform the best, the better your account performance is going to be as well. But if you're a little more averse to risk, maybe you just don't know what you're doing, not very knowledgeable, or maybe you're close to or in retirement and you just don't want to have 100% of your money in stocks for now. No problem. It's your money, your prerogative. We're just giving you information here to work with and do your own homework and make your own decisions based on what research you're doing. And this presentation here is part of your research. But if you need a little bit more diversification right now, then I recommend a 70% stocks versus 30% bonds distribution. Personally, I would just stick only with the G Fund, C Fund, and S Fund as far as TSP is concerned. So in other words, if you want diversification, go 30% in the G Fund and then go any kind of a mix between the C and S funds. I personally like the S Fund more than the C Fund at the moment because with what growth we are seeing, it's more it's fueled more by domestically than it is from foreign sources. The S&P 500 is more internationally focused, so a lot of more of their revenues and profits are based on demand from foreign sources. So when global demand is lower and domestic demand is stronger, I tend to like the S Fund better than the C Fund. When international demand is stronger, I tend to like the C and I funds more, or particularly the C Fund, maybe the I Fund too, depending on what's going on with other foreign economic data, things like that. But anyway, like I said, my recommendations, you can always find them anytime in the announcement post on the TSP Facebook group. You never have to ask about what's the current recommendation. Just go to the darn announcement post. I update the post regularly. When I do update it, I have a note. I have a line right there at the very top that you can see without even trying what day I last updated it, and right below there it tells you what the most recent change was that I made to that post. On top of that, I also post a separate announcement alert post, whatever, to let people know. They'll let y'all know in more detail what I changed in the announcement post and why I changed it. So to keep up with that announcement post and keep watching for those update posts from me as well, you can always stay a little more up to speed on when you should make any adjustments to your account. So that covers that part for now. Let's move on now. Okay, the rest of this a little bit more informational in nature. Over the first quarter, we had 6 constituent changes in the S&P 500. It's very common for the index to see about 2 dozen or so constituent changes over the course of a year. Right on pace here. Although the last two, the two most recent ones on March 20, those were kind of weird. Because what happened here, it's really the same stock symbols that got replaced and added to the index. What happened was it used to be known as 21st Century Fox, which basically was the all-encompassing entity of Fox, basically. Just think of, Fox has a movie industry. They have a TV news channels, or network channels, whatever. They have all these different little breakdowns of their broadcasting capabilities. what basically happened there was they sold the movie part of it to Disney Corporation, and basically Fox remained. They held on to their TV broadcasting portion, and they're still big enough to where they were able to stay in the S&P 500 as well. So that's why that actually happened there. But this just gives you kind of an idea of what's going on. I also want you guys to know, who are not very familiar with the way stock indexes work, they always weed out the weak links, and they always replace those weak links with stronger up and coming companies from small lower level indexes. As far as the S&P 500 is concerned, if this were like baseball, this would be like major leagues. The next level down would be like if it was like a AAA baseball team. The stock market equivalent would be the S&P 400 mid cap index, and then the AA league would be like the S&P 600 small cap index. So basically, as companies get bigger and bigger, they get promoted to higher and higher levels, and the highest level as far as Standard & Poor's indexes are concerned is the S&P 500. So you never have to worry about companies going bankrupt, wiping out all your money when you're investing in index funds. If a company does go bankrupt, or even before they go bankrupt. In fact, like here's one I hear: PG&E, they filed for bankruptcy. It doesn't mean they're going out of business. They just I don't want to be talking bad about PG&E, even though I should, because personal experiences with them. But they're not the only company that's filed for Chapter 11. And as I say, JCPenney in the past did. They're still around. But the index, but the S&P actually does have a listing requirement. As soon as a company files for bankruptcy, they're automatically ineligible to remain in the index, which is why PG&E got removed from the index back in January. But some of these other constituent changes, it could be because, like say this one here, Scana, they were acquired by fellow S&P 500 constituent Dominion Energy, so they were placed in the index by First Republic Bank, which is a regional bank. Another one, Newfield Exploration, was they were removed because they were bought out by another company. Goodyear Tire. Did I put the wrong symbol in there? Okay. No, actually, so Goodyear Tire spun off holding part of its holdings into a separate company that was acquired by Wabtec, which made Wabtec big enough to come into the index. And because Goodyear Tire was at the bottom end of the market cap ranking, they got bumped out of the index. And then, of course, these last 2 years with 21st Century Fox becoming Fox. This is just more informational for you and give you an idea, though, with indexes. You don't have to worry about stock indexes losing all their value forever. That just won't ever happen. They're designed to never do that. They're always designed to continually increase in value over the long term. All right, moving on. Okay, sector earnings health. What we're basically doing here is getting an idea on how many companies in each of the sectors reported positive earnings growth versus negative growth. The more blue you see, the better it is. The more orange you see, the worse it is. So at the strong end, you see industrials, healthcare, info technology, and communication services, and consumer discretionary companies. They all perform strongly, and these are good These are good sectors to see at the strong end. Anytime you see things like infotech and consumer discretionary and now communication services. This used to be telecommunications, which used to be more of a defensive sector, but with the very recent classification changes that took place, some of the companies that were in other sectors got moved into the communication services sector, and it's no longer such a defensive sector that it used to be. The more defensive sectors are actually these three here that are at the bottom end, which is actually what you want to see. Consumer staples, real estate, and utilities are defensive sectors, What I mean by defensive sectors is that during periods of recession, those sectors tend to be the ones that perform the best. They might take losses, but they won't take losses as strongly as these companies over here on this end will when bear markets and recessions are happening. So again, this is another bullish sign here. Now, what to expect over the next quarter? Okay, still, I mean, now they're orange and gray this time, but still mostly the same thing here. It's not so strong, but it's still, there's still enough orange there to say we should be okay. Moving on here. This is a new feature that I just started adding to these presentations, and that's also research in progress on my end. I'm trying to just get an idea of find any correlations that take place between how many companies are reporting increases or decreases in their dividend sizes, and comparing that to what's actually going on with stock prices and the broader economy. Not every company in the index pays a dividend, but as you see, a pretty good number of them do. The bottom table here, this tells you how many companies in that particular sector are actually reporting, actually have a dividend that they pay. I think there were 2 companies that I looked at that just recently announced dividends that they previously did not pay, and I think there was one company where the dividend was decreased, where it was actually cut completely. But otherwise, most all these dividends were either just that could be small or large gains or increases, or small or large decreases. But basically, just want to get an idea of what the sentiment is from companies in the sectors. The idea here is that companies are not going to increase their dividends when they're more pessimistic on what the future holds. So if they think that if they're more concerned that their earnings are going to flatten out or even start to drop, they're not likely going to increase their dividend. They're more likely just going to leave it where it's at until they're a little more comfortable with how much, what they have to give back to investors. Now, for those of you who were around in 2014, I think it is, when we had the energy sector recession, which basically the rest of the index was doing just kind of flat, just slightly positive, but energy sector was single-handedly holding the entire index down. Well, during that point in time, a large number of the energy sector companies were reducing and even completely eliminating their dividends because of all the declining earnings they were reporting, and a number of them were even getting into the red as far as for a whole entire year they were actually losing money, where they were spending more money than they were getting back in revenues. Now, speaking of energy sector, this is something else I need to point out here as far as this top table is concerned. Fourth quarter, you see how it said 0? It wasn't really 0. What happened was I decided to start doing this after I had already looked at the energy sector and made all the changes to that particular sector. All the other sectors I looked at after I'd already decided I was going to start doing this information. And so in reality, this 159 that you see here, as far as the broader index in fourth quarter, was actually higher. You see there are 29 companies in the energy sector that pay dividends currently. Last quarter, it could have been, I don't know, it could have been a good 5 to, at least maybe even up to 10 companies for all I know, that out of those 29 who might have reported dividend increases. So in reality, this 159 could have been closer to 170 for all I know. So comparing last quarter to this quarter, though, the total, the score is, I should say, is down to 110. Now, as far as the score is concerned, what I'm doing is basically every dividend increase is +1. Every dividend decrease is -1 as far as the score is concerned. So communication services, there were 3 dividend increases and 1 decrease. So they would have a score of +2, as you see right here. And then consumer discretionary, 13 of the 49 companies that pay dividends, or actually, I forgot about this table, this column here. 13 increased their dividends, 1 decreased. So they have a score of plus 12, as you see here. So on and so on. Looking at each sector across the board, they're all mostly lower. Consumer staples was definitely lower. Energy, I really can't give a good number on because, like I said, I don't have record. I didn't take note of which of those companies increase their dividends or how many, whatever. But across the board, they are lower all the way across, except for utilities, where all 11 of them are actually, well, I forgot, there's 12 increases and 1 decrease. So we're still seeing dividend increases across the board overall. It's just not as strong as it was last quarter. As we get more to a more pessimistic situation here as far as earnings growth is concerned, we should theoretically see these dividend number scores, whatever, drop closer and closer to zero. And if we get into recession time, or actually I should say a negative earnings growth time, because that's different than recession, when companies begin to report declining earnings, we might even begin to see negative numbers on these totals at some point in time. Again, this is all theory. It's just going to take time for all of this to play out to see what really does happen. But the more, like I say, in theory, this is what should be happening. And if we keep watching it, it's just another indicator to see what, kind of get a ballpark idea of how optimistic or pessimistic companies in the actual indexes whose shares you're buying or selling actually are themselves about their future growth. All right, moving on. This is the last slide here. Credit default data. This is also from S&P and Experian. Basically, this gives you kind of an idea of what's going on with credit default rates between auto loans, credit cards, and mortgages. What's going on here? We do have a slight upward trend lately over the last few years with credit cards, but nothing really alarming at all right now. In fact, the default rates dropped in 2018, and it's kind of working its way back a little bit now. Ultimately, when people are pinching for pennies, the first credit they stop paying on are the credit cards. The next ones they quit paying on tend to be the auto loans, and then the last ones, they'll try everything they can to keep their home loans, and they'll let other things go into default before they'll let the mortgages go into default on a normal basis. What we really see here, though, is credit card rates are mostly stable, but like I say, trending slightly up over the last few years. But auto and mortgage default rates actually are looking good. They're very stable. In fact, mortgage defaults, they were at parity with auto loan defaults in 2015, and now they're at a point where they're lower than they are today than they are in 2015, and they're even lower now than they were than what the auto loans were. Or not were, but they're even lower today than the auto loans are now. So this is actually a positive sign here. We do want to keep an eye on what's going on with the credit card default rates, over the longer term, but it's nothing really alarming here again. So I wouldn't worry too much about any of this. It's just one of the indicators. This kind of gives us a basic idea of what's going on with the broader economy. That's all it is. All right, anyway, that's all I have as far as this presentation is concerned. Let me know, please, if you learned anything good and interesting or valuable from this presentation. If you have any questions at all, don't hesitate to ask. For those of you in the group, remember Mondays, Wednesdays, and Fridays is when we have the questions of the day. If you have questions in general, put them in as comments in those QOD posts that you see me post every Monday, Wednesday, and Friday morning. The reason why we do this, for those of you who aren't really sure, or just, maybe like, why can't you just post it on your own? The reason why is because we have a lot of other informative posts that get put out every single day, like what's going on with the markets, maybe some articles that get posted, from other investment professionals or quote unquote experts or whatever, just sentiment kind of posts, whatever. We don't want those getting pushed down to the point where it's harder for people to find those particular posts when those are what matter the most to them. So, we do ask that if you're newer to the group and you have questions, use those QOD posts. But even better, before you even go asking questions in the QOD post, please, please, please look in the announcement post first. There's plenty of good information in there, and a lot of times the QOD posts, questions that I see, I'm frequently answering those questions with, why aren't you looking at the announcement post? That answer to your question is right there in the announcement post. Look at it. It's a long post, but there's a lot of good information in it for you to look at. It has information on my performance, Deb's performance, or I don't think Deb's performance, but it does have where's my money distributed right now? Where's Deb's money distributed right now? Where is she putting her new contribution allocations? What's in the S&P 500's value at right now and over the next 4 quarters? What are the recommended distributions? I have information on all those right there. What stock or bond indexes do each of the TSP funds actually follow? That's all in there. Guess what? It never fails. Every single day on QOD posts, there's always at least 2 or 3 people asking questions that trigger, hey, go look at the announcement post. Also in the announcement post, there's a link to the FAQ file or FAQ, frequently asked questions in the group. You can access the FAQ file from either the announcement post or through the file section of the group. Either way. There's a PDF version of it that's linked directly in the announcement post, and there's also both the PDF and document versions in the files section. And there's a whole bunch of other good files that you can also be looking at in the file section since I mentioned it. So, and I hope you got a lot of good information out of this. Please, don't hesitate to ask questions if you do need help. And aside from what I already discussed there is a search tool on Facebook also. Trust me, you're going to find a lot of good discussions on anything that might interest you. Very seldom do we come across questions that haven't already been discussed numerous times in the past. So you might end up getting a lot of good reading material just by using that search tool. But yeah, I don't want to discourage you from asking questions, but I do want to discourage you from asking questions without bothering to do any other legwork first. Very easy to find a lot of information, but a lot of people don't look for it. But anyway, that's all I have for now. I'll give you another presentation next quarter as far let you know how the second quarter looks. Also, hopefully, we'll be giving one here pretty soon on how the ISM reports are. ISM is the Institute for Supply Management. They always put out 2 reports at the beginning of each month. What it is a survey. They ask questions to a bunch of different businesses and all the different industries. Hey, what's your sentiment on whether you're growing or contracting in this area or that area? That's what those reports cover, and we can get a lot of hints about what's going on with the economy from those reports. So they're very important and reports to me. If they're important to me, they should be important to you as well. But nobody seems to know about them outside of those who actually invest heavily. So just keep your eyes out for that if you want to learn more and get some more ideas. But that's all I have for now. Just enough rambling for me. So enjoy. Thanks.